afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and welcome to the final 2023 webinar hosted by Barometer. Today, we will be joined by Diana Avador, our Head of Trading. She's our special guest on this final webcast of 2023. And of course, David Burrows, our Chief Investment Officer and CEO here at Barometer, pleased to provide you a macro overview of what's happening in the markets, a quick recap of what's happened in 2023, and a little glimpse into what is to come in 2024. David, we always get birthday wishes for you at this time of year because we know your birthday is just around the corner. So a big happy birthday from our team to you as we head into Christmas. And on that note, I leave you with the rest of the afternoon to provide our viewers with great insight.
Great.
So on that note, Dave, happy holidays.
Thank you. Happy holidays to you too, Pamela. Thanks so much, everybody, for joining. Yeah, this is going to be the last webcast for the year. I don't expect too many fireworks between here and year end, although certainly markets are in gear and returns are stacking up a little bit. It's been a great 6 weeks in the market since the late part of October 30th. But we are seeing some character changes, which I think is important to stay on top of. It's been a tricky market for people over the course of the year. I asked Diana to join us today. She's going to give a little bit of trading color and talk a little bit about some of the things that we've all been dealing with and you know, really what's been happening underneath the surface. As always, I just want to start from a high level. From an equity perspective, we're in a structural bull market. And this has been going on since 2013. Sometimes it sure hasn't felt like it. But like in every other structural bull market in blue, there are significant pullbacks and there are cyclical bear markets. And the trick is to recognize that you still remain in one so long as we don't take that second step into something that turns into a structural bear market. Structural bear markets, like the ones 1973-74, they tend to have very deep declines. They tend to start as a market sell-off and turn into a credit event that pushes things a lot lower. In a structural bear market, we stay range bound for years and years at a time, and every asset class has them. Equities have them. Domestic equities have them, global equities have them. They often are at different times. Commodities have them, fixed income has them. But we've been in a structural bull market in stocks. And one of the ways that we've characterized that, this shows the bull market of the 80s and 90s, 82, 81 through 2000, and then 2013 through present. And in both cases, you can see we basically remained lower bound by the rising to 200-week moving average. And we have short, sharp pullbacks. In some of the cases, they last a longer time. 1990 to 91 was 18 months. And the net of it was about a 23% pullback top to bottom. And this one, has been a long one. It's felt difficult. It's been 24 months. But look at that. We're now just 0.1% below the old highs in the S&P from December of 2021. But, what a ride it's been. It's been difficult emotionally for people. It's tested people's patience. Certainly, I know it's tested ours, especially given the fact that, not so long ago, we went through the COVID sell-off in 2020 and the Fed tightening tantrum in 2018. So, lots of things that investors have been through. And you can understand why it is that, given the geopolitical stuff that's been going on, and given the Fed tightening cycle and the tightening going on around the world, lots of investors have been shaken out of the market. Money's been coming out of equities all year long. If we look at, the last 2 years, we've been pretty steadfast in our view that October 22 was the cyclical low. It doesn't mean it goes straight up from there. We've had a series of higher lows since then. We broke the downtrend in April of this year. And then we had another little pullback in May, and a good sized seasonal pullback, 10%, happened from the end of July through the end of October. Now, our breadth models that we use turned down in the first week of August, turned back up again the first week of November. Sure felt pretty good, going into August after a nice rally coming off the spring lows. But thankfully, when we recognized the breadth was changing, we got a little more defensive and mitigated that decline. And on the other hand, we weren't very popular when we sort of got more positive at the end of October, given the fact that there was so many things to worry about. So here we are. We're now within a whisper of the old highs. And the S&P certainly has been led by large cap stocks. That's for sure over the course of this year, the biggest stocks having a big impact. We've had a number of situations where we had a very significant, statistically significant signals driven along the way. For instance, the one that happened, in the beginning of November when the market had declined by 10% or more and then held its low for 10 days and gained 9 out of 10 days following that. 1 year out returns were positive 100% of the time, double digits. We know that, a large part of the returns this year have been driven by the very biggest stocks. And this is a chart from a couple of weeks ago where, the S&P top 7 were up 80%. The rest of the market was basically flat on the year. Now that started to change. We said that this was a very unusual event. You had to go back to 1965, where the 5 largest stocks had had a bigger impact. And realistically, it's unlikely that most people have, just the 5 biggest stocks in their portfolio. We all tend to have diversified portfolios. But we mentioned a couple of weeks ago that for the first time in a while, we're seeing the equally weighted S&P, where every stock gets a single vote, outperforming the market cap weighted, that index that's so heavily driven by the biggest stocks. And that's continued on. So we think this is a significant shift. Historically, there are periods of time where market cap weighted does much better, but it doesn't go on forever. One of the things that we note is, since in the last little while, mid cap stocks have really started to lift through November and December. In fact, mid cap ETF IJJ, which is a little more value bent, is just making new all-time highs. And that's after a 2-year period of really no returns. Now, we highlighted before, there have been periods where if you took the market cap weighted versus the equally weighted, some years where the market cap weighted did much better. This year, up to November, market cap weighted S&P had a bigger outperformance this year than in the biggest previous year, which was 1998. But on average, the equally weighted S&P has outperformed by a couple of percent. And there have been lots of years you can see where equal weight did much better than the market cap weighted. So, things don't go on forever. Market leadership factors change, and we have to remain open to the fact that we can see a change in the nature of the market. And I think it would be welcomed. I think virtually everybody is way behind the benchmark this year because of that heavy concentration. In our local market here in Canada, the S&P TSX has started to act a little better. It's been putting in higher lows, although much slower to get back toward highs than the S&P. But we've just broken trend in the last week to get above these recent declining highs. And I think that that's a welcome change. And I think, we have to take note of what's happening in the background. We talked a lot about the US dollar. US dollar often is a flight to safety. And through 2022 in the bear market, money was flowing into the US dollar. And look at that, the dollar peaked around the time where the stock market bottomed in October of 22. And then as the market corrected this year from August through October, US dollar rallied versus virtually all currencies, Japanese yen, euro, British pound, etc. And then it sort of topped out. And with yields backing off and the dollar backing off, it's really taken the pressure off of risk assets. Part of it has to do with the market starting to look beyond the Fed's tightening cycle. And we've had some interesting impacts. Now, we've talked about the fact that Japan after 40 years of no returns, broke out in the last 18 months and has been marching higher. We've talked about India, which has continued to strengthen coming out of a multi-year decade bear market. We've seen a lift in the shares in Mexico, probably partly because of the reshoring of manufacturing to North America. We've seen strength in Latin America, ILF, the ETF, or Brazil. So interesting. But this, outperformance of the largest stocks has really been outsized and unlikely to repeat. Now, not every global market's done well. We've continued to sort of stay away from China. China continues to be really getting compressed from a share price perspective. The Chinese market is down about 80% from the highs back in 2015, now going on 8-9 years in a bear market. Very difficult there. Moving on to fixed income, beating this horse to death, generational low in 2020. And we've seen rates rising since then. And what works during rising rates, like through the 50s and 60s and 70s, is generally quite different than what works during falling rates. So again, understand the structural backdrop. We're in a reflating world. Now, when we look at the 10-year yield, it broke trend back here in 2022. It's been working its way higher from 50 basis points in 2020. We've pulled back for a couple of months. And with yields pulling back, bonds got a bit of a bid. US dollars pulled back a little pressure's been taken off. And while it's better for bonds than it has been, there's other things that have been doing well. Certainly commodities came out of their bear market over the last couple of years, and a couple of months ago, 4 or 5 months ago, started to look beyond the Fed tightening cycle. And despite lots of concerns about recession, the market's telling us a different story. Now, they've kind of gone sideways over the last 4 months. Underneath the surface, some are doing better, some are doing worse. I think it's interesting that copper, after a multi-year bear market, has broken out of the range that it's been trading in to the upside. That's not very recessionary. That may just be that after 10 years of a bear market in copper, the demand side has grown and the supply side hasn't. It looks like we're going to have a shortage next year. There are companies having difficulty meeting their production targets, and there are geopolitical issues that are hampering things. It takes a long time to put copper mines into production, but certain commodities certainly doing better. We talked about gold, and gold has broken out of this very large cup and handle technical formation. So this is a bear market that broke out, consolidated, and we're at the early stages, it looks like, of getting up and above that resistance. And when that happens, you tend to have a long rise in price. So again, that's a change, and we have to recognize that change. If you were to talk to 25 investors, you'd find 25 investors that are bearish on gold because it hasn't worked, really since 2010, 11. So you got to stay open to change. So commodities relative to equal weight S&P have broken out of a consolidation, retested from the top side. My guess is we work our way higher from here. So that's kind of a backdrop. Now, we don't need to be everywhere. I think people hire us to try to identify the structural backdrop and understand what's actually happening in the market, make sure our portfolios are in tune and that we're focused in areas of the market that have a tailwind. Often, things will behave differently than you might expect given all the news that you read. Now, I asked Diana to join today because Diana's job as our trader not only is to, execute on transactions and make things happen in the portfolios, but her job is to have her kind of ear to the ground, be talking to 20 or 24 different trading desks to understand what they're hearing and thinking, try to understand what may be influencing securities of ours that we might not be considering. And she's a little bit more granular on markets than we are. But I thought I'd maybe ask her some of the really big things that she's noticed over the course of the year, because of course it's not been an easy year for people, emotionally for sure. What are your thoughts, Diana? Oh, you're muted. It's hardest for us to hear you.
Thanks, Dave. Sorry about that. Thanks, Dave. You're absolutely right. The last 2 years have been difficult emotionally. 22 was a big down year for people. The 2018 tightening tantrum happened again in 2022. But in 2018, Fed Chair Powell, he bullied by Trump, relented, and turned it around. And instead of raising rates, he cut 4 times. But in 2022, we had him go on and go on a rate hike that is one of the fastest in history. So it certainly made people ready to move out of stocks all year after the 2022 experience. And then towards the end of the year, as the equal weight S&P started to move, as the market started to broaden out, people have started to try and chase it to catch up as flows have left stocks all year and moved into bonds in order to finally, after 2 decades, get yourself a secure 5% yield return. But as you were watching the stock market move up on you, 5% suddenly seems, and by the way, 5% pre-tax turns to be a little less attractive than what the equities have done, even long term, which is double that. So as the market started widening out through the what you showed in the equal weight versus the top, the Mag 7 as they call it. And by the way, Mag 7 is 30% of the S&P. There's no way that a prudent portfolio manager is able to have 8% Apple in your portfolio when you're running a diversified portfolio. So lots of chasing to catch up. And as rates have declined, Powell did a pivot a week or so ago. Yields have come down from 5% high to below 4%. Financial flows have increased as the financials have not really done much all year. And Canadian banks, for example, some of them are yielding as much as 6 and 7, and at some point was 8% on Bank of Nova Scotia. So dividend growers have worked all year. The market all year has been calling the Fed's bluff. Really, Fed wanted to make sure that financial conditions were as tight as they can be. Used to be really hawkish, wanted to talk market down, and the market discounted it. There was tons of speakers, lots of headlines, all hawkish, and the market was just working through walls of worry. There has been really low IPO activity. The market is a capital raising platform. It has been really low IPO activity as evidence of low confidence. And we've battled 2 wars, geopolitics and big Fed tightening. So sentiment fought all market all year. And so now in the last, actually triggered by at the end of October and November was a huge month. Flows have been incredibly high. Now, the long only community, the mutual funds, the pension funds, the big money has been absent all year, which rendered the stock market very vulnerable to the systematic flows, which were very bearish for most of the year until yields started coming down, and then the vol control funds and the systematic non-price sensitive that were so underweight really put money to work in a big way. We're talking about $100 billion, $120 billion over the month of October, November. And that really was able to move the market a lot in the absence of the big pension mutual funds. This plays into our hands a little bit because, we listen to the market as opposed to the headlines, and the headlines have been very negative. We came into the year making recession feel like a fact. Well, really, it was not a fact. We don't get a pandemic every recession. Pandemic comes once every 100 years, and the bottlenecks on the supply side were really high. And if you were to look at the components of the CPI, that has really been worked off. We still have some inflation on the wage front, which is actually good because people making money. The labor market is very strong. You hear about all these, all these deals on the union side, but though that's again headline, that's only 10% of the labor force. So it's good that wages are holding in, people have jobs. And in Canada, for example, I just saw a data point that that people not paying their mortgages is at an all-time low. So the consumer's balance sheet is in good shape, and that's what basically pushing the market up. If you look at the data points on the retail side, on the consumption side, Black Friday, Cyber Monday was unexpectedly higher than what was put out there in terms of expectations. And so all of these surprises, all the while the City Economic Surprise Index is coming down and was at the low, but it was on the good side. It was on the pricing side, whereas the demand side stayed where it should be. And that meant the market and people had to keep repricing and repricing, and the market just kept on moving up. So what we see now into year end, we've seen the highest expiry last Friday. People have bought a lot of insurance over the year because they were so bearish, and all expired out of the money. And the dealer on the other side go out and rehedge themselves and buy back everything that they sold in order to hedge whatever insurance that they sold to the market. There's $6 trillion in cash. Cash and bonds have garnered most of the flows this year. There's lots of money to be put to work, absent a crisis. And, we've heard the last few days that there's been geopolitical anxiety in the Suez Canal, and market hasn't blinked. Commodities exposure out there because the Mag 7 has worked so much. Commodity exposure, and because of China, commodity exposure is pretty low, and there's lots of money to be put to work. So, yeah, so Goldilocks. I don't want to say it's different this time, but I would just bring everybody back to the fact that we don't have a pandemic every recession. So there could be something in here.
I think those are great points. And all year long we've looked at economically sensitive groups acting pretty well, despite the fact that many people have said with almost certainty, and I even heard somebody guarantee, that there's no guarantees in the market, and we have to keep our wits about us and just follow the work. So our job is to recognize change. It's not to be everywhere. Our job is to play defense when required. We've had to do that a little bit over the course of the year, certainly through the fall. But what I want to do is just kind of talk through what we're seeing through the lens that we look through, right? We think 80% of return comes from being in the right asset classes, the ones with the tailwind, and then finding the sectors or themes that are seeing net inflows. Be in the right neighborhood. 20% of return is finding securities that are good, getting better. Find the right securities to express your views. So we use our top-down work, which is breadth driven, looking for universes of securities where over time a higher and higher percentage of securities are performing well. It means money's getting put to work. There's no way around that. Where we can find areas that are seeing expanding breadth, and then find securities from the universe that we look at that are fundamentally sound, are technically attractive, and showing good relative strength versus their peers. Well, that's where our portfolio is going to live. And that way we address each of the factors, get to the right asset class, find the right sectors, and then find securities in those sectors that are, not broken getting fixed, but that are good already and getting better, where multiples can expand as money gets put to work. And then we run our selling strategy, which is running stop losses and trailing stops to make sure that little mistakes don't turn into big ones, or that our gains don't go away by sitting through an advance and then a full scale decline. The top-down work is all driven by breadth. So we're trying to find when a group is better out of favor. Generally, one company or two companies turn up first against the grain. And then as things start to change and the opinion starts to change, buying starts to spread to more and more securities. Any group that's going through expanding breadth is improving. you've got a tailwind. There's no bear market in history ever took place while breadth was expanding, either at the market level or in a sector. Now, you can eventually get to a point where people believe the group is bulletproof and the leaders are marching on. And quietly under the surface, some of the laggards start to peel away and sell off. By tracking breadth, it helps us to recognize when a group starts to lose steam. And it may be the leaders continue on, but if the weaklings are rolling over, eventually it'll get to the stronger and stronger companies. So we run these models that help us to track where there's expanding breadth. That's areas we want to focus on. Where the breadth is contracting, those are things we want to stay away from. And those are the things we want to be pairing holdings in. We run our stop losses so that if our models are weakening and are getting stopped out of positions, our cash position builds. Now, as it sits right now, we don't have a ton of cash. The end of October, the breadth models were solidly negative, and they had been so since the beginning of August. Percent of stocks in Canada performing well had got to a very low number. Percent of stocks performing well in the US got to about 20%. Percent of stocks perform in uptrends globally got to about 35%. And when we look at the percent of stocks trading above their 50-day moving averages or 10-week moving averages, again, you were down in the teens. So these had all been solidly and steadily weakening. Now you fast forward 6 weeks and the picture looks very different. Okay, we have breadth in Canada expanding, breadth in the US. Now almost just around 60% of stocks in the NYSE are in uptrends. So 6 out of 10. You throw darts, 6 of the 10 stocks you hit are working their way higher. The higher breadth gets, the easier it is to make money. And we can get to points where 70 or 80% of stocks are performing well, and it can stay that way for a year at a time. So this is a time when we want to be putting money to work. We want to have seen the companies that were performing well before the market started getting better. It meant they're very resilient. When you look at the US market now, 80% of stocks are trading above their 50-day moving average. That means 80% of stocks are trading above their, short-term trends. And percent of stocks making new highs versus new lows, 85% on a given day, right? 8.5 stocks making new highs versus 1.5 stocks making new lows. So in the end of October, if we took all the sectors and put them on a distribution curve, with the left side of the distribution curve, meaning a very small percentage of stocks were in uptrends, and the right side, meaning a high percent are in it. We're all stacked down here. All the sectors having a difficult time. The strongest groups, interestingly, were most economically sensitive. Now we fast forward 6 weeks, different looking picture. You can see all of them are in capital letters. That means all of the ones in capital letters have been seeing an expanding number of stocks in uptrends. You can see that the vast number of these sectors have moved to the right. And in fact, the average sector now has 50% of stocks in uptrends. There's 2 sectors that still have little rain clouds that are still in small letters. And these are sectors that did well early in the year, and they're oil and oil service. Breadth is not expanding there. There's some good stocks and there's some bad stocks. The oil sector has 39% of stocks in uptrends, which means 60% are in downtrends. We're not putting any new money to work there. And it means that if we get stopped out, we get stopped out, and our energy weight has been compressed. Having said that, banks, now 70% of banks in uptrends. Home builders, over 75% of stocks in the home building sector, including the materials providers, in uptrends. So this week, the average sector bullish percent or percent of stocks in uptrends is up another 3%. So long as this is going on, it's a healthy market. Money's getting put to work. The fact that so many are showing expansion, again, it's healthy. It means that there's ability to diversify. So the market is getting stronger. Now, let's look inside and see what's happening. Technology, this is the XLK, the ETF made up by the largest of large cap stocks, continues to march along. Relative strength, this small blue line at the bottom, if it's rising, it means it's outperforming the market. So it's flattened out a little bit relative to the market recently, meaning other things are doing well. It's doing just fine, right? It's continued to perform well. Now, if we take the biggest 7 stocks relative to the long bond, they started to wane a little bit. or their dominance is starting to wane, that's something to watch. They're still acting fine, but it means that maybe there's some other things to do. Within tech, the strongest group actually has been in the cybersecurity group, right? This is the HACK ETF, made up of a number of companies that do security, cybersecurity. And given some of the hostilities going on in the world and some of the things that are happening, companies being taken hostage, you can understand why they're spending money. Relative strength is rising sharply. You know, Palo Alto is one of the holdings that we have in this group. Cloud, or the companies benefiting from the proliferation of AI, obviously is doing very, very well. And that includes companies like Microsoft and IBM, which are holders of ours, and Amazon. Semiconductors within this group. Again, really nice pickup in relative strength. Nice move off the lows in October. Of course, important in here would be companies like NVIDIA, which we have some exposure, or Broadcom. I mentioned that mid-cap stocks are doing a little bit better. This is CGI Group, a newer holding that we've added over the last little while. It's been in a range since May, between sort of 142 on the high end, 127 on the low end. This last 2 weeks, we've broken out to new highs, something we're always watching for. So financials. Now, financials are a broadly diversified group. I mean, even if you look at this XLF ETF, you can see that JP Morgan's the number 2 holding, Berkshire Hathaway is the number 1 holding. Berkshire Hathaway, of course, the insurance company that happens also to have a lot of very large private company investments. So not a bank, but they are seen as a financial. In the financials all year long, the insurance stocks have performed well, and we've talked a lot about them. Within the banks, it was a very narrow market. But over the course of time, money has moved into other areas. Visa is one holding that we have. It's in our top 10. Visa is a dividend growth stock. Doesn't pay a high dividend, but they grow their dividend kind of 15, 18% a year. It's been trading at new highs recently. It's had steadily rising relative price strength. But as we talked about, JP Morgan, has been the leader in the banks. You can see the relative strength on JP Morgan has been improving since 4 months or 5 months before the market made its low in October of 22. So again, leaders generally start to do better than the market before the market bottoms. And relative strength has been rising ever since. It happens that this is probably the highest quality bank. It's been the one with the least amount of risk. 2.5% dividend that's been growing at about 10%. Their earnings in 2023 are expected to be up 40%. So this has been a core holding. Now, over the last 6 weeks, we have added some more additional bank exposure. After getting down to no banks in Canada, we added CIBC and we added some BMO. Yield's pretty good. Relative strength has changed. It's starting to improve, and it's an important group in the market. Now, there may well be headwinds in the Canadian economy, but the market's telling us a different story, that things are getting a little bit better. So we have to start. We start with partial positions, and if they continue to work, then we can always add them. We've got to stay open to change. Now, industrial's been relatively outperforming since 2020. This has been steady. Part of it likely due to the fact that we're reshoring manufacturing. And big companies who are providing equipment are benefiting. Now, when you look at construction spending on manufacturing in the US, you can see what's happening. There's a lot of new factories being built, some of them semiconductor facilities, some of them battery plants, but there's all kinds of ancillary manufacturing taking place, which probably is benefiting Mexico as well. Eaton Corp, one of our larger holdings, they provide electrical power and control systems and hydraulic systems used in all kinds of different industries. Going to grow their earnings this year, 19%. Again, not a big dividend, 1.5%, but growing at high single digits. Aerospace has been a group we've been in all year. Again, look at the rally through September. Bottomed prior to the market low in October. And has put in a higher low in the late part of October. And since the market look at how quickly it took off and relative strengths continue to improve. So between focusing on defense and focusing on smaller cap industrials, which tend to be more domestically focused, also relatively outperforming. One of the great examples in our portfolio currently is Howmet Aerospace, which serves both civil and defense aerospace. They make all kinds of fastening systems and forged products and engine products sold around the world. Growing earnings over 20%. Again, a dividend grower. Moving on to materials. A little while ago, we said, look, it's interesting in these groups that have had 10 years of doing nothing, broke out and then went through the tightening cycle, they were starting to show change. So this is the uranium sector, and that's been an important one. There are a lot of people who believe that the only way we're going to get a stable, higher level base load of electricity is to build on our nuclear power facilities. Here in Canada, Ontario is really focused on growing their nuclear production, and they're actually working with one of the companies we're invested with, BWXT, which ran all the small nuclear reactors for the Navy, or does and has done for 50 years. But the companies in the uranium space are going to quote, well, Cameco's been one. They've waned a little bit over the last few days, not a big deal. Steel, again, this is a group I watch for signs that we're headed into some kind of economic weakness. The steel ETF made a new high yesterday. It was right on the verge of breaking out, and then Nippon Steel and Telit Steel made a bid for U.S. Steel. And so interestingly, making a new high here. Long-term bear market that breaks out, consolidated, then moves on. These are things that are looking at the next economic cycle. So all of these things, by the fact that they've absorbed a Fed tightening cycle and are now breaking out to make new highs, tells me that they are relevant sectors to be focused on for the upcoming, 2 or 3 or 4 years of the economic cycle. Metals and mining as a group, the XME ETF, broke out 2 weeks ago, now working its way higher. This is just the beginning of a new bull market. Now, this includes steel, it includes gold, it includes copper miners, includes base metals. Certainly, it's important to look at. Timber for the home building industry, it's broken out of the range that it was in all year long and working its way to the upside. Again, likely the beginning of a longer term bull market. We have Stella-Jones that produces telephone poles and railway ties. All of these things play into one of the most important themes, infrastructure. So we know how much money the US committed to spending on infrastructure, and whether the Fed was tightening or not, companies who have cash and need to reshore, or infrastructure programs that are going to be funded, need materials. And this is the PAVE ETF for infrastructure spending. This is made up of engineering companies and so on. You can see what the market's saying about that. So these things play into companies like Rio Tinto, one of our top 10 holdings. Now, Rio Tinto went through a bear market in the early 2000s. When it broke out, it consolidated. And then when it finally started to move, it went up 520% until we got to the financial crisis in 2008. Now, it went through a bear market from 2011 through 2021, broke out, went through a Fed tightening cycle, and now is breaking out through the upside. So we think that these are things that could have years of legs in front of them. Happens to be nice that it pays a 5% dividend and is likely to grow the dividend in the high teens over the next number of years. But this group is feast or famine, and when it exits a bear market, moves into a bull market, there's money to be made. I mentioned gold breaking out to new highs. That favors companies like Kinross. Now, Kinross is one of the only companies that is now trading sort of at 52-week highs, trading better than 90% of companies in the S&P, pays a 3.6% dividend, grew its dividend this year 30%. So we don't want to get caught up in what things have been doing. We want to get caught up in what they're doing now and recognize change and be there for the process. If we're headed into bad recession, it's highly unlikely that the home builders would be making new highs. Now, in the consumer, we've been a little bit more targeted. There are some companies that are really benefiting from the economic environment. Costco is one of them. Certainly, the market really liked the earnings, and they really like the special dividend. But this is one that's had a really good go here at top 10 position. And some of the other positions in consumer that have worked well for us, like Bellring Brands, which is protein drinks. Let's talk about energy just for a minute. Now, energy looks a lot like the rest of the commodity space in that it's been through a bear market that started in 2015. The index went down 90%, recovered and made new highs in 2022, and then went through a Fed tightening cycle. One of the first groups to break out of that range, and over the last few weeks has pulled back. You can see relative strength pulling back sharply. So the question is, will the weakness in energy wash through the whole energy sector? And I think the jury is out. We can see that relative strength along the way has pulled back a couple of times into trend. We've done that recently. The question is whether we hold here at the moving averages and rally or not. All companies aren't the same. And for us, we've held the stronger positions and we've reduced some weaker ones. Certainly since the early October, energy prices have pulled back against geopolitical events that you would expect would push energy higher. One of our big holdings is Canadian Natural Resources. And again, it broke out and has pulled back into the rising moving average. At this point, we're still there. It's paying us a 5% dividend. Dividend growth rate this year is 23%. They're generating tons of free cash, and it trades at a relatively low multiple. So we'll see, but we're going through these one by one. Groups that have been out of favor all year long, are they changing? Consumer staples, relative strength continues to weaken, actually at a new relative strength low today. It's had a little rally, but rallying less than the market. Healthcare, rallying, but rallying less than the market, relative strength new lows. Utilities, rallying, but rallying less than the market. Telecom, same picture. So these groups have been out of favor all year long. They continue to be relative underperformers. It may well be that there's tax loss selling going on here in these groups and that pressure may come off. If it does, we can certainly look at it. But right now, we would just say relative strength continues to be weak in these groups. The one group that looks like it's trying to make a little turn is real estate. We'll see. We've done nothing here yet. We're looking. But at this point, our sense is that there's two important themes that we want to recognize. Dividend growth securities relative to high dividend payers, and those groups are all high dividend payers with low dividend growth. Dividend growth has been outperforming all year long, and it continues to. When bonds started to improve, we said it's possible bonds are going to bounce here, but my guess is that if yields come down, there are other things that will benefit more. So the aggregate bond index has rallied about 6% since the end of October. The dividend growth ETF is up 16%, actually better than the equally weighted S&P. So focus on the strength. Dividend growth versus high dividend payers continues to be the play. And for those people who are looking for recession, high beta or more economically sensitive versus low beta, low risk seen securities, high beta is just made a new 2-year, 3-year high versus low beta. So I think that the market is telling us that the economy is more resilient than we think. There's a lot of cash on the sidelines that can support markets. So as a result, we're pretty fully invested. We've taken our financials weight from a 15% weight a month ago to 21% as the banks have started to improve their performance. Our technology weight has risen partly because we added a little bit of a couple of new positions, but frankly, part of it because the group is acting well. Industrials weight has been taken up substantially. because it's really one of the most interesting groups from our work's perspective. Materials right now, again, moved up from 6%. Market cap, market weight is 2.5%, so it's a significant overweight. Energy has come down, and we're going to let energy prove it to us. Right now, there's other things that we can focus on. Consumer staples up slightly. We've taken down our short-term bond position, using them to put on some of these positions. Healthcare, consumer discretionary, communication services, real estate, and utilities remain significant underweights in the portfolio. There's just no evidence that there's a tailwind in those groups. We're in a market where it pays to be tactical. Now, in our income portfolio, which can go anywhere for yield, just to touch on it, the dividend yield is a little higher than the market. The PE is significantly lower. It's a very interesting portfolio. The average holding has had, the holdings on average have had just about 10% dividend growth a year over the last 5 years. It's expected to be about that over the next 3 years. We think this probably moves higher. And from a market cap standpoint, size, the average company within our income portfolio is a much smaller market cap, about 9 billion, versus the average company in our benchmark, which is at 45 billion. So we're trying to take advantage of dividend growth as opposed to high dividends. We're trying to take advantage of mid-sized companies, and we're trying to take advantage of high dividend growth. Last couple of things. Bitcoin, only because people are interested, continues to look like it's working its way out of the third major bear market it's had since the beginning. Certainly relative to stocks, it's acting a little bit better. So we do have a position in our macro portfolio. From a credit risk perspective, bond investors clearly believe that credit risk is falling because the cost to insure against default is falling. And volatility relative to the last 30 years is now in the low end of the range and in the range where stocks tend to do quite well. So we look at breadth every day to see if there's changes. Things are getting better. We focus on recognizing change in volatility. We focus on recognizing change in the premium bond investors are asking for to take corporate credit risk. We look at our sector work every day, and we're ready to make changes when required. We've said now for the last 2 years, our job is to get to the end of a cyclical bear market intact and in a position to take advantage of the 2 or 3 years that come after a cyclical bear market, because that's where you build your returns. And I think that we're in a really good position to do that. We come out of this year, there's a ton of cash on the sidelines, a lot of people underinvested. We think that that money is going to work its way into the market. We're in a seasonally strong period through until April. We're in a period where small and mid-cap stocks tend to do well. We're getting through the period where tax loss selling has an influence on the market. And we're going to watch for change, and we're ready to make change if it's required. But we think that we got a pretty good opportunity going forward. So 2023 looks like it's close to a wrap. November was great. December looks like it's going to be pretty good, but we're really looking forward to next year. Pamela, any questions?
Yes, Dave, we have a couple questions here. The first comes from Lorenzo. He's asking here, David, I've seen analyst charts that show a correlation between inverted yield curves and a looming recession. What are your thoughts?
Well, my thoughts are that economists have called 12 out of the last 8 recessions. I don't mean to be glib, but there is no simple rule that captures everything. It's been a long time since we went through a global pandemic where people stockpiled cash. And so things appear to be a little more resilient than people would otherwise have expected. The Fed is now openly talking about the potential of cuts before there was ever really a pickup in unemployment. That would be the first time. So there's a first time for lots of things. The one thing that I can say is it's possible that there is a recession out there. but it'll start showing up in the economically sensitive parts of the market. It's not going to go from a Friday, things being strong, to horrible on Monday morning. Things change and evolve, and that's why we watch these breadth models. The reason the breadth models are important is when so many people stare at the price of an ETF, and the ETF's being driven by the very largest 2 or 3 companies in the group. We want to know what's going on under the surface, what's happening with the weaker companies. But when day by day, the percentage of stocks in uptrends is expanding, you can't argue that. There's no recession about to hit us in the face if that's the case. If a recession starts to become a higher probability, breadth will start to weaken, and that will give us plenty of opportunity to change our stance. But right now, it looks like most people are on the wrong foot. So we'll keep assessing. We don't know the future. All we know is the direction that things are going, and we want to make sure that our portfolios stay aligned with what's actually happening in the market today.
Thanks so much, Dave. The next question comes from Raj. He says, David, thanks for all the great info. Regarding financials, do you invest in preferred shares? Yields are high as some reset, but they seem to underperform the common stocks over time.
Yeah, we really don't tend to buy preferred shares. Part of the reason is that so many of them have terms that favor the company and not the investor. So you put on a preferred share, and then it turns out that they have the right to redeem when rates go lower and they want to refinance. It just, we don't think that the risk reward is that great. There are certain times in the market they make sense. But right now, we look at those as being fixed income. And while fixed income is performing a little better after, a 3-year horrible bear market, the worst bear market in fixed income ever, you think about it, they started to do a little better in the 4th week of October. And since then, bonds are up 6%, the equal weight S&P's up 16. So our sense is that there's better opportunities in the equity market. We've said over time, in the last period where rates rose for an extended period of time, they started rising in the late 1940s and rose until 1981. If you looked at the first 15 years, 1950 through 1966, bonds went up 1.6% a year and stocks went up 15% a year. Right? They outperformed bonds over 5 to 1. So we think that's the world that we're in. If we're in a reflating world, there are sectors that have been out of favor for a decade that could outperform for many years. And we think there's a better opportunity there. And we'd rather get a rising stream of dividends than a fixed stream of dividends. So that's why we're looking at dividend growth stocks.
Thanks so much, Dave. The next question comes from Roger. He wants to know your thoughts on the ECB cutting rates and whether it would strengthen the USD DXY impacting commodities. And he says, thanks so much. Great work as always.
Yeah, I think so. I think that the dollar is driven by a couple of things. Part of it is rate differentials. And part of it is, is there something else to do with the money? Like some of that money is in US dollars is there as a safety trade because there's nothing else to do. So my sense is that we're starting to see global markets do a lot better. My sense is probably that safety premium in the US dollar is going to come out. And that's without getting into a whole discussion about the fact that we've moved into a multipolar world where you've got, Russia and China and Saudi and Brazil, maybe on the other side of the coin, looking at trying to find an alternative to the US dollar, which is a tall order. But at this point, just recognize the dollar is weakening. And while it's weakening or even benign, other things can do well.
Final question of 2023 from Sanjay. He asks, will the Suez Canal issue become a headwind for the economy? And he also says, birthday wishes, David, and Merry Christmas to all at Barometer. Thanks so much for all the information.
Well, that's very kind.
Happy holidays.
Certainly we're watching it. I think that one of the biggest takeaways today is that, you've got problem with the Suez Canal, and really energy did very little to react. So I think that's probably my biggest takeaway. I think shipping costs are probably going to get a little tighter, and we'll see how long it lasts. But market, I love the fact that you had the Russell 2000 up close to 2% today, and the S&P was up 50 basis points. NASDAQ's up 50 basis points. Equal weight S&P up 80 basis points. This equal weight outperformance is a big deal. It really benefits the individual investor because the market becomes a lot more of a sorting hat and less just about the biggest stocks in the market. Money is clearly being put to work in picking and choosing. The disparity between good stocks and bad stocks is significant. So we can be tactical and pick our neighborhoods and pick our stocks within those neighborhoods. And I think that we're seeing over the last couple of months, things really start to stand out. And I think it makes for an interesting 2024. So changes for next year. One thing that I think stays the same right now is that the most defensive sectors are not showing a sign of changing their spots. We haven't done anything to add there. I do think that mid cap stocks and small cap stocks likely can do better over the next 24 months. We're doing a little bit more there. And economically sensitive stocks that have been threatening to work their way higher seem to be doing that. And I think that we get an opportunity to generate some returns there. So anyway, to everybody, thank you so much for joining us. I know that some of the stuff we do look at each week is repetitive, but it's just a test to see if things are remaining the same. And where we see changes, we try and highlight them. If you got things that you'd love us to cover in topics in the upcoming year, please send them in to us. If you got stuff you'd like to talk to us about, we're in the business of growing our business, and we're always happy to talk to new folks. And for the clients that are on the line today, we really appreciate you being a client, and look forward to talking to you in the new year. Thanks, everybody. Thanks, Pamela.
Thanks, Dave and Diana.
Thanks, Diana.